Today's video is my take on a popular technique known as the anti-method. The variation of this technique that I will cover today is based on a 310 oscillator. Well, you don't have to worry if you have never heard of this oscillator. We will use MACD indicator to create this oscillator. This technique was first made popular by a well-known trader and investor, Linda Raschke. Her original variant, first introduced in her book Street Smarts, is based on stochastic oscillator. I will cover that in a future video. For today, we'll focus on the one that's based on 310 oscillator. But before we do that, let me show you something. Here is a 15-minute price chart with two added MACD indicators. One with default settings while the other has faster settings. As you can notice, when the price does a pullback, our default MACD chart misses this altogether, whereas the modified chart more effectively identifies this due to the increased sensitivity. Our technique today involves customizing MACD settings to be more responsive to market movements, enabling traders to identify trends and potential reversals more swiftly compared to conventional MACD configuration. Well, I won't spend too much time today introducing the MACD indicator itself. If you're looking for a detailed breakdown, check out my earlier video where I've explained this in detail. Now let's jump straight to the settings. The MACD indicator typically uses a few key parameters: the fast length, the slow length, signal length, and the type of moving averages to be applied. By default, when you add the MACD indicator to your chart, these settings are usually set up as follows. You will see that the fast length is set up as 12, slow length is set up as 26. The signal line length would be set up as 9, and the type of moving averages which is associated with MACD indicator is the exponential moving average type. Now let's see how we can change the settings of MACD indicator to convert this into a 310 oscillator. First, we will shorten the fast length to just 3 and the slow length to 10, making the indicator much more responsive to price action. What this basically means that the price for fast length will be taking average of 3 periods, whereas for slow length it will be limiting itself to only 10 periods. But what really stands out for me is the bold decision to change the average type from EMA to simple moving average. This is quite a crucial shift because by reducing the number of periods and opting for equal weight, which is by the use of SMA, the method provides a faster moving oscillator that can catch trends early, but at the same time, it comes with a trade-off in the form of more frequent signals. Therefore, by using a simple moving average, we are giving equal weight to all the periods. So, in short, we have lowered the period lengths, switched the average type to SMA, and in doing so, created an oscillator that's much quicker at spotting shifts in the market compared to MACD. As a final step, as we do not intend to use the traditional MACD crossover, we will go to the Style tab and switch off the histogram. Now what we have is the 310 oscillator with only oscillator line and the signal line being visible. And that's it. What you see on your screen now is the 310 oscillator. Now we are all set to move to our main act, the strategy, the essential components necessary for establishing this trade. Our first step is to establish the direction of existing trend. We will focus on a bullish pattern for now. Begin by looking for a market move that shows clear bullish movement. Remember that we are looking for clear and persistent formation, not a short-term upward move. You can see that the market is making a clear bullish run with continuous higher highs over here. It is important to note that the anti-pattern is a continuation strategy, so it only works best when there is an existing bullish trend. The second step of our strategy is to spot the counter trend movement. Wait for a sudden sharp pullback or drop in price. This is a counter trend move, which might look alarming, but it's often temporary. Typically, this drop is triggered by short-term market reactions, such as profit taking, any news about the stock, or traders closing long positions. Observe whether the price movement is more dramatic than the usual pullback in this trend, and it should be a clear one that stands out as a pullback. Step 3. We now monitor the behavior of our oscillator line. As the counter trend movement happens, turn your attention to the oscillator line. A key sign of the anti-pattern is when the oscillator line makes a new high higher than its previous peak, even though the price hasn't made a higher high yet. This is a divergence and it's crucial to our setup. The oscillator line is essentially leading the price, suggesting that the market momentum is preparing for another bullish move. An important point to note is that divergence between the oscillator line and the price action is the hallmark of this setup. The oscillator line gives us the early signal before the price confirms the trend. Our next step is to check the slope of the signal line. We will pay close attention to the slope of the signal line during this phase. As the oscillator line moves higher, the signal line will start sloping upwards as well, confirming the buildup of a bullish momentum. The upward slope of the signal line is an additional confirmation that the trend is resuming in the bullish direction. Why does it matter? This upward slope aligns with the oscillator line's higher high, giving us more confidence in the validity of this setup. Okay, step 5. Now we will wait for the oscillator line to show the reversion. This is the final step before entering a trade. The reversion phase indicates that the market is consolidating after the counter trend move and the bulls are now gaining control. We will wait for the point until this line shows the first sign of reversing upwards, and that is where we move into our final step, which is opening the trade in the direction of the original trend. It's important to note that as this is a counter trend move, it is important to note that we make the trades using the right risk to reward ratio, typically 1:1 or 1:1.5, and always use a stop loss. I hope you liked this video and my take on the famous yet secret anti-method. Please leave your thoughts and questions in the comments section below. Also let me know if there is any specific topic that you would like to cover in a future video.